How's it going, everyone? Welcome to another video in SMTFX. In this specific video, I'm going to be covering how to take continuation trades. Now, I know some of you have been looking at my charts. You might be wondering, Neith, how are you taking these trades? And today, I took continuation trades on Aussie dollar, right? And I sort of explained briefly in the forecast how I was going to take my trades and what the reasoning behind it was. So I'm just going to briefly cover why I basically took my trades on Aussie dollar. So when before the market opened, right, we were basically at let's say somewhere around here, right, or even slightly about here. Market opened, went all the way down here. And the idea was we want to take long trades up to, first of all, cover the gap that was created by the market. And the second thing was we want to take trades towards the supply zone we have over here. So basically what I did was I took continuation trades on Aussie dollar all the way up to fill this gap here. My take profit target was where this gap started and where it basically ended over here. So I took continuation trades up. So I'm going to briefly explain how continuation trades work. Now, in the market, you'll see two types of order flow. You'll see bullish order flow, right? You'll probably see bullish order flow when the market is trending, in a bullish manner, and you will see bearish order flow. So these are the two types of order flows you'll see in the market, right? The first way that bullish order flow looks like is basically like this. You have higher highs being created, higher lows being created along the way, right? So one of the things to note is that when we are creating higher highs and higher lows, there typically is mitigations in each point of that high low being created. There are mitigation points here, 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 and here. So along the way up, you can basically take trades towards the direction of the order flow being created. Now, sometimes you'll see price basically go down, and then we change our order flow and we start creating higher highs and higher lows. That's the point where you can try and find an initial trade all the way below where the order flow first started. So let's say you have a trade around here. This is just an example. You have a trade running, right? This is the first trade you take. And as we create more higher highs and higher lows, sorry, let me draw this again. Higher highs and higher lows. You can look for trades along the market as the order flow continues up. Okay, so essentially how the trade or mechanics of this is whenever we create more highs, right? We create highs, highs, highs. We want to look to see whether there is a valid mitigation point here where it makes sense for price to come back, mitigate, and continue up. And if there isn't a valid mitigation point, then you just don't take that trade, right? But if you see valid mitigation points here, then you can safely take a trade here. However, I would say that when you want to take continuation trades, there are a few points you must remember. Is that you want to have an initial trade running up, okay? And if you decide to take continuation trades without this initial trade, you have to be aware of how the market is moving. If you see a chock or some sort of a change in bias, or you see price pushing down very aggressively, so maybe you see something like this, price moving, and then as it's approaching here, you see it approaching really fast and aggressively. You don't want to see price doing like pushing down aggressively. You want to see price gradually moving down with a few candles. You don't want to see one large candle, and one big candle just approaching that zone really aggressively, because chances are you might get taken out if you put a trade there. So this is bullish order flow. You notice how bullish order flow moves. You know that there's going to be mitigations along the way up, because that's how the market creates itself, right? We create higher highs and we create higher lows. Now for bearish order flow, it's the exact same thing, it's just the opposite direction. You're going to see the market move like this. We're going to be creating lower lows and lower highs, right? As we approach the market down, we're going to be creating more lows and more lower highs. Now, in these regions, you're going to see valid mitigation points for them as well. And we basically follow order flow down, and we can take continuation trades in these regions down. Should you take every single continuation trade? Hell no. Don't take every single continuation trade. Take the ones that look the clearest and are the most visible, because sometimes you might see something like this where you have clear mitigations. Sometimes it might look like this, right? Sometimes, this point doesn't come up here to mitigate it, but you have a clear mitigation here. So don't try and take every single mitigation you see, or every single continuation trade, but take the ones that are clear, right? The ones that match your criteria and the ones that make the most sense. Okay, so conceptually speaking, this is how continuation trades are taken. Okay, so let's have a look at Aussie dollar, right, as an example, since I've just traded it today, and I can briefly tell you how I took these trades. So what I'm gonna do is I'm gonna go to a replay tool. I'm gonna go back here, and I'm gonna use the line graph so you can see visibly what's happening. And if we look at the 3-minute time frame, you can see that maybe 2 minutes works as well. Yeah, 3 minutes is gonna be clearer. You're gonna see that we are creating higher highs here, higher lows, higher high, higher low, higher high, higher low, and we just continue up essentially, right? And one of the biggest indication for me was we had this mitigation here, and we have this gap to fill. So that was enough for me to go, okay, it makes complete sense for me to try and look for mitigation or continuation trades up to follow the market as it pushes up. Now, the first indication for me that it is likely possible for me to take a continuation trade was this mitigation point here. We are following the bullish order flow. And in this point here, you can see that sometimes bullish order flow doesn't look as clean as I showed you previously, right? It's going to look messy like this sometimes, where we create higher highs, all of a sudden we create a low. We continue creating highs and we create a low here. Then we create highs and a higher low, higher high, higher low, and we continue. So sometimes you might see that the market isn't exactly following how this looks, of course. This is really easy to draw and tell people this is how bullish order flow looks like. But you have to be aware that the market does not always look textbook, because the market moves as it wishes. So one thing to note is that the market might seem a bit messy, but you have to look at the overall picture. One of the ways to confirm that we are in a bullish order flow is to see whether we have any supply zones being broken. We have one being broken here, another one being broken here. So as we continue up, and you notice that, oh, okay, price is breaking through all the supply zones and it's mitigating all the demand zones. Now that is the biggest indication that we are currently in bullish order flow. Okay, so using that concept, I would definitely suggest that you guys look at your own charts, mark up areas in the market where you see bullish order flow clearly. When you found that, have a look at price and see if you can find any mitigation points as well as potential trades that you can take in the market. Now, some of you, when you finish doing it, you might be like, not too sure whether this is correct. That's why the community is here for you, right? Once you're done with it, pop it in the chat, right? Ask us, tag any of us, and go, hey, does this look right? I've noticed that this is forming bullish order flow, but I'm not too sure if these trades make sense. Just pop it in and we will be more than happy to help you, okay? So let me just dive back into this. So the first initial mitigation was this point, and I knew before this we were forming bullish order flow, right? Now at this point, I did not take the trade yet because what time was this? About 4:45. Yeah, so I wasn't really looking at the charts properly at this point. So what I did was I looked at the this was the 30 seconds time frame. Yeah, 30-second time frame. So at this point, I usually, with the market, I want to see, I could have taken this trade. But what I did was I popped onto the 30 seconds and I went, okay, is there a proper chalk indicating that price is going to follow up with the mitigation here? And we had a 30-second chalk here, over here. And this chalk only makes sense because we have reacted to a valid demand zone here, and we have bullish order flow that is occurring before this. Okay, so make sure that you don't just mark any chalk and go, okay, price is going to reverse. That's not how chalks work. Chalks do not work on its own alone. It requires a number of confluences before you can actually safely say that, okay, yeah, this chalk is telling me that price is reversing, or it's moving in the direction that you want it to move into, right? So at this point, we have this beautiful inside bar here. We have a chalk and we have a supply zone failing over here. We have a sort of liquidity grab here because of all these liquidity that has been generated. We have equal highs, equal lows here, and that was swept as well. So this was a decent liquidity grab. And why do I class it as a liquidity grab? Because we wick and immediately push up. So that was the first continuation trade I took. I'm not saying you need to drop to the 30-second time frame to take a trade. That is absolutely not what I mean, because this was taken clearly on the seconds, right? And if you look over here, this was a decent 1 minute trade that was taken that sadly hit break even. However, the next one here was a trade that was clearly visible on the 1 minute, and you could have taken it on the 1 minute easily with a 2 pip stop loss and still have made. So this one brought me 24.6. If you have a 2 pip stop, that's 12R, which is still a decent amount of percentage to gain in less than, I'd say, about 4 hours. Yeah, about 3 hours or 4 hours. So that is decent enough. With 12R, you could literally either not even trade for the whole week or the whole month, depending on how much money you require for the month or how much money you need to survive, right? So this was the other trade I took. 1 minute, really, really visible. Unfortunately, as price pushed up, because of this supply zone here, I put my stop loss break even early. However, if I did not do that, price would have still continued going up, and this trade would have been an absolute banger as well. If we mark up, that would have been another 27R that I would have gotten. But because of the nature of how price was here, I do not regret putting this to break even, because price could have reversed from this supply zone. This trade as well, very, very highly likely. We have the supply zone being broken, and that also tells us that, look, first supply zone broken here, this one was respected, pushed down, broke the supply zone, continued forming higher highs, highs, and we continued pushing up. Okay, so essentially, if you look on the line graph, this is a prime example of how your continuation trades will look. And if you're unable to figure out whether price, is forming bullish or bearish order flow, I highly suggest you use the line graph tool, and that will give you a clear direction of where price is moving. So the line graph tool is really helpful in terms of looking at what sort of order flow price is forming, and that gives you a great indication of where you can take your mitigations or where mitigations are happening. So that will be all for this video, guys. This was a quick example of how the continuation trades were taken on Aussie dollar, and I hope you guys learned about my continuation trade method. There isn't really a specific method in a sense, because all we're doing is we are looking at the order flow that is formed and we are following the order flow up, right? You don't want to be against the order flow. The order flow is a insanely large sum of money that is pushing price in the direction it wishes to move towards. So if you fight against that, you are most likely going to lose. And when you follow the order flow, you are trading pro trend. You're not counter trend. So be sure to follow the order flow and just flow with the flow. Sounds funny, but flow with the order flow. That'll be all for this video, guys. I hope you enjoyed it. If you have any questions, feel free to drop me or Chris a message, and we will be happy to answer your questions.